All right, for more on all the recent data, economic data and investing, let's now welcome in Wei Li, BlackRock Global Chief Investment Strategist. Wei, thank you for being here today. We've been talking about some of the economic data that's coming out, and we're looking ahead to Friday's big payroll numbers. Just give us, please, your thoughts on how things are evolving here on the economic front, because we're always keeping an eye of what the Fed is thinking of them as well.
Absolutely. Hi there. Good morning. Thanks for having me. So indeed, the ISM manufacturing data was poor, surprising on the downside. It's been steadily decreasing for months now, but now it's at the lowest level in 3 years. And what jumped out to me in those components that you just broke down is just how poor those new orders are. All of this reinforces our view that we are entering a recession. This is a recession foretold, and it is perhaps going to be exacerbated by the credit crunch that can come from the banking turmoil that is playing out in the U.S. And if you look at what markets are currently pricing with S&P 500 above 4,100, it's really pricing in growth to take off, and also central banks cutting rates to come to the rescue of the economy, which when you look at the kind of elevated inflation numbers, cue the PCE number last Friday and also CPI number coming up next week, it's hard to really expect central banks to be able to cut rates, right? So when you bring all of that together, in our view, the macro damage that we expect for the U.S. economy is not really being priced in by markets at this juncture, which is why we are modestly underweight U.S. equities at this moment, and we are positive and overweight on emerging markets at this juncture, which seem to be more fairly pricing in what is to come.
You know, even as we have kicked off the second quarter of this year, and looking back at all the things that the beginning of 2023 has brought, even the fireworks at the tail end with the banking crisis and turmoil that ensued, that still, as Jamie Dimon put it in his letter this morning, will have ramifications that we haven't seen the full breadth of to this point. We think about some of these surprises that we could potentially still see in the second quarter of this year and even further out into the rest of the year. What would be those surprises that you're keeping an eye on? Perhaps some of those anomaly type of events that you have to still safeguard against if you are an investor and trying to position your portfolio against some of those events?
We're trying to put our head around the magnitude of this credit crunch that could happen in response to the banking turmoil, right? So we're talking about the economics of deposit playing out and what that means for the funding cost for some of these regional banks, but also for lending appetite. Maybe they will have to rein in lending a little bit, and what does that mean for the demand side of the economy? What does that mean for credit creation? What does that mean for central bank response mechanism, right? So if we see greater demand destruction, perhaps it means a lower peak in terms of central bank rate hiking cycle. But given the inflationary dynamics, we do not think that they will be able to cut rates. So there are some disconnects between what we believe would transpire versus what markets are currently hoping and pricing for. I would also draw your attention to geopolitical developments, right? We talked about kind of the OPEC cut, and that's the latest kind of geopolitical development that has been playing out. But as focus has been very much on the banking turmoil, there have been also other geopolitical pieces playing out that normally would take a lot longer time, but now they are playing out within a much shorter period of time, pushing up oil prices, pushing up the pace of decoupling between spheres of influence between U.S. and China. So that's something that I'm paying very close attention to as we think about the rest of the year. The last thing I would say, to answer your question, is fundamentals and earnings as we kick off the earnings season in less than 2 weeks' time. So far, if you look at markets year to date, it's been a very macro market, right? So you look at what's been driving U.S. equity return, actually more than 90% of the return is explainable by the 7 large cap tech names. So it's been a very strong duration trade. Those long duration names responding well to markets pricing in cuts. But it is our belief that focus would shift to fundamentals, shift to earnings. And on that front, we're already seeing signs of margins compression, earnings contracting for the first time since late 2020. Markets have yet to take note of that, but those developments are happening. We're forecasting a mild earnings contraction. It's not quite in the price, and we're paying attention to that as well.
Well, let me ask you, so what do you expect for Q1 earnings season, which kicks off in about a week or two?
Absolutely. We are expecting earnings margin compression to further accelerate. There are signs of that coming through in response to higher funding cost, higher labor cost, and higher production cost. But there is more room for margin to fall. And at the same time, if you look at the fact that actually revenue growth is outpacing earnings growth, so we're essentially looking at negative operating leverage that is set to continue as well. We also think that as we enter this recession foretold later this year, there is going to be greater dispersion within the equity market across sectors, but even within sectors, which is why we pay particular attention to companies, quality companies that are able to grow their earnings, that are able to generate free cash flow, that are able to withstand the higher cost of production and pass that through, so larger pricing power as we enter recession. So greater selectivity is key when it comes to investing, and greater expectation for dispersion as we enter the earnings season is what we would expect.
Wait, while we have you here as well, I'm just kind of thinking about some of the through lines that I've been drawing from your CEO, Larry Fink's, his annual letter, and talking about ESG, and particularly one of the things that jumped out to me, climate risk is investment risk. That also coming up during Jamin Diamond's investment and shareholder letter as well. When we think about how people can best position what the public policy needs to do in order to get ahead of climate risk, in order to best kind of invest and set their portfolio strategy going forward, what do you tell people who ask you about where they can insert a concerted or at least a smart climate approach into their own holdings too?
We do think that climate risk is investment risk, which is why in our capital market assumption, we incorporate the impact of climate change in our asset return forecast, which underpins our strategic sectorial preference for the likes of technology and healthcare in our strategic asset allocation. I would also say that last year, alongside energy sectors performing well, renewable energies have also been performing really well. So in the context of geopolitical fragmentation, we do believe that the transition in certain parts of the world could be accelerated. And the last thing I would say is that as we think about kind of this net zero transition, this net zero journey, there's no template. We have never done this before. So as we think about what that means for macro outlook and inflationary forecast, we do believe that it represents a series of supply shocks that we also need to kind of protect our portfolios against. This is one of the reasons that we believe that inflation is likely going to settle at a level that is higher than the pre-pandemic level, which is also why we believe that inflation protecting your portfolio, especially over the longer term horizon, is critical.
BlackRock Global Chief Investment Strategist Wei Li. Wei, always great to get some of your time, and thanks for joining us here at the opening bell.
Thanks for having me.